Maybe you've seen that the market is down at the moment. Deep inside, you know you should be investing right now, but which stock should you buy? Hey, welcome to Stock Market Mate. In this video, we're going to talk about a surprisingly simple screening method used by value investors such as Warren Buffett that reliably finds you winner stocks amongst the thousands of publicly traded businesses in the market. But before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Many people think that the first step in finding a great stock is to simply figure out which ones are the cheapest. You may be paying attention to what has the lowest PE ratio or what the stock screener returns to you as the most affordable option. But we're going to tell you that's just plain wrong. If you intend to choose this investment for the long term, it is a risky and bad practice to base your stock selection on the price. In actuality, the necessary initial action is to Step 1. Find companies you understand. What stocks does Warren Buffett steer clear of first? Buffett steers clear of undertaking uncharted investments. This is precisely why Berkshire Hathaway's portfolio lacks a significant amount of high-growth technology firms or biotech stocks. We're not suggesting they don't have potential or are awful companies, but Buffett is aware of his best stock-picking areas. Investing in too complicated investments, in the opinion of Buffett, is one of the simplest ways to make a mistake that could have been avoided. Most of us have worked in a small number of industries throughout our whole lives. Having said that, we presumably have a very good idea of how these specific marketplaces function and who the top corporations in the region are. But the great majority of publicly traded businesses operate in industries in which we have little to no expertise. But don't get us wrong, this does not mean that you should avoid making financial investments in these market segments. We're just saying that you should proceed with caution. Just remember that there are too many fish in the sea to get hung up on studying a company or business that is just too hard to understand. Step 2. Know you're betting on yourself. It's imperative that you comprehend the game you're playing before you start coming up with your strategy for being the next Warren Buffett. By choosing to select individual equities, you're placing a wager in your capacity to outperform the general stock market and produce greater returns. This is quite challenging to accomplish. After 5 years, 84% of professional fund managers whose sole responsibility is to outperform the index have failed to do so. 95% of managers fail at the task after 20 years. According to S&P Global's SPIVA US Scorecard research. Maybe there's a better chance for retail investors? They don't, as it turns out. In the 20 full years between 2000 and 2021, the S&P 500 grew at a 9.5% annualized rate. The average investor earned just 3.6% annually, barely outpacing the 2.2% tax levied by inflation, according to JP Morgan Asset Management. The poor actualized returns of average investors are mostly the result of psychological errors like overtrading, purchasing when equities are up, and selling when they are down. So although this principle may be the least appealing, it is also the most crucial. You're exercising a little vanity and choosing to go against the odds by deciding to pick stocks rather than investing in a low-cost index fund that automatically generates market returns, such as the Vanguard 500 Index Fund. Step 3. Determine whether a company has a competitive advantage. Now that you're considering a whole bunch of companies and their competitors, it's time to start narrowing down the list. The most important thing to look for in a company is a sustainable competitive advantage, or what Warren Buffett calls a moat. The key to investing is not assessing how much an industry is going to affect society, or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. Buffett said in a 1999 interview with Fortune, "The products or services that have wide, sustainable moats around them are the ones that deliver rewards to investors." A moat can come from several different sources. Learning about how factors such as scale, switching costs, unique brands, intellectual property, and the network effect can give a company a strong advantage over its competitors will help you identify them in the companies you're researching. Step 5. Determine a fair price for the stock. After narrowing down the list of stocks you're considering to companies with a strong competitive advantage, it's time to start looking at stock prices. There are a lot of ways to evaluate a stock's current price and whether or not it presents a good value. Here are a few. Price to sales ratio. The PS ratio is more useful for growth stocks that aren't profitable or produce very unstable earnings. Again, historical averages can be a good guide, but be sure to factor in future expectations. Importantly, not all sales are created equal. A company may come out with a new product or service that produces a much different profit margin than its core business but accounts for the majority of its revenue growth. As a result, investors need to adjust their expectations for how the stock should price relative to future sales. Price to earnings ratio. The PE ratio takes a company's share price and divides it by its earnings per share over the past year. Investors can find stocks trading for a good price when their PE ratio falls below its historic average. This metric is best used by well-established companies producing steady profits and growth. But there may be a good reason for a stock to trade at a higher PE ratio than it has before. If earnings growth is expected to accelerate over the next few years, investors should be willing to pay more per dollar of profits. Remember, stock prices are determined by future expectations. The past can only be used as a rough guide. Discounted cash flow modeling. If you really want to get into the weeds, dig into the financials of a business and start making projections for revenue growth, profit margin, and other expenses for the next several years. Then use those projections for revenue and operating expenses to develop a model for future earnings. Discount those cash flows by your required rate of return and you'll have an estimate of the stock's value. Divide that by the number of shares outstanding and you'll have a reasonable stock price. Dividend yield. If you're focused on income, the dividend yield is another important metric to consider. If the dividend yield is above average for a stock, that could indicate it's trading at a good price. However, be sure you don't fall into a yield trap. Sometimes dividends are unsustainable, so be sure to check how safe the dividend is based on a company's payout ratio as a percentage of earnings and free cash flow. And be sure to look forward and check that the earnings and cash flow are sustainable and growing. You may even develop your own dividend discount model by projecting dividend growth over the next several years. Step 6. Buy a stock with a margin of safety. The last step to stock picking is to buy companies trading below your estimate for a fair price. This is your margin of safety. In other words, if your valuation is wrong, you're preventing big losses by buying well below your fair price. That's another key to Warren Buffett's success as an investor. For a stock with stable earnings and a strong outlook, you might not need a wide margin of safety. Take 10% off your target price and you'll probably be fine. For growth stocks with less predictable earnings, you may want a wider margin of safety. Aim for 15% to 30%, depending on how confident you are in your valuation. That ensures that if things don't go as expected, for example, if the young company faces a new challenge or a larger company decides to enter the market, you'll be protected because you bought your shares at a relative value. There's no need to get the absolute lowest price possible for a stock. Trust yourself that you did the research necessary to make a good decision, and when the price looks good, take it. If you follow the above steps and build a diversified portfolio of stock picks across several sectors, you'll be sure to find some winning investments. Well, that's about everything. Hopefully this guide, along with Warren Buffett's advice, will help you in your journey toward investing in 2022. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!